Let's start out and let's talk about taxes for a minute. Taxes are actually the largest asset protection threat that you have. The IRS is going to take, what, 30, 40, 50% of everything you ever make? That's a pretty big asset protection hit if you ask me. The point of the matter is that you've got to control your taxes. You can't leave it up to your accountant because your accountant just plugs the numbers in. He takes whatever you give him on that questionnaire thing that you hand out, that he hands out to you, and then he just puts those numbers in the computer, and the computer spits out your taxes. That's not tax planning. The problem is a good CPA isn't going to tell you how to do the tax planning. He's not going to give you the good stuff. And the question is, why? It's not what you think it is. He makes more money because your taxes become a little more complicated, but hey, if you're going to be making an extra $5,000 this year, would it be worth spending an extra $200 on your tax return? I think so. It's not because the guy doesn't know about it. The guy knows all about the things that we're going to talk about. What we're talking about are black letter tax laws. He knows all about them. Why won't he tell you about them then? Well, that's easy. He doesn't want to take on the liability. If he tells you to do something, he tells you to use a family limited partnership. Fine. You go down, you set up a family limited partnership. It's going to cost you $5,000 at the lawyer's office. You go through all this work. You get everything all set up. And next week, Congress changes its mind. And by the way, does Congress ever change its mind? Yeah, I think so. That's what we pay them for. Congress changes its mind and does away with all of the tax advantages to a family limited partnership. If that happens, who are you going to be mad at? Who are you going to sue? You sue the accountant guy who told you to do this. Or at a minimum, you're going to go in and yell at him because you wasted $5,000. So the accountants have learned to keep their mouth shut. It's not worth the liability hit to suggest anything to you. So they keep their mouth shut. That means you're going to have to understand it. You're going to have to learn about it all by yourself. And if you go in and you say, hey, Mr. Accountant, let's do this, this, and this, the accountant guy's going to look at you and he's going to say, wow, you're smarter than you look. That's a good idea. And he will do it for you. But unless you ask, it isn't going to happen. As a result, people just sit there and they pay their taxes year after year after year. Now, I'm not saying that you can do away with paying income taxes. No, you're going to pay some income taxes, but I think our goal, good goal, let's put this as a good goal, huh, guys? Good goal is to cut your taxes by 10 or 20%, and that's a big deal. I'm going to teach you what kind of a big deal that is in just a second. So, the ultimate goal is to live well and not show a big income. You don't want a big income today. You might remember the Wall Street occupiers a while back. They were stamping up and down and they were screaming, and you could hear them actually yell, let's kill everybody who makes over $250. That $250 is $250,000 in adjusted gross income. We're going to talk about adjusted gross income in just a minute, but the point is, if you make a lot of money today, you are a target in today's society. Unfortunately, the attitude today is, if you've got a lot, we're going to take it away from you, and we're going to give it to everybody who doesn't have much because we need income equality. Isn't that what they're saying? That's what they're saying. So let's use tax shelters wherever they are. Oh, you're saying tax shelters, bad word. Bad word, tax shelters. Actually, tax shelters are a bad word in many respects because there are a lot of scams going around as to ways that you can shelter income from taxes. Well, we don't have to worry about that. We're going to talk about the 11 tax shelters that are left in the IRS code. And they're not weird, wacky things. Let's look at maybe your home interest deduction. That's a tax shelter. Your home is a tax shelter. You get to sell it if you live in it 2 out of 5 years, and you get the $500,000 tax-free and blah, blah, blah. That's a tax shelter. How about retirement plans, 401ks, IRAs, all of these retirement plans? They are excellent tax shelters. Benefit plans. How can you get your benefits, your dental, your medical, your accident, your health insurance, all of this stuff? How do you make it pre-tax, tax deductible? That's a tax shelter. Oh, and one other thing, you can hire felons. If you hire a felon, the IRS will give you a credit for the entire amount of money that you pay the felon during the year. Now, this is the favorite trick of law firms. They all hire the felons. Half the attorneys are felons, so they just hire another attorney each year, and they get a tax deduction. No, 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 no. That's a joke, okay? But you can get a tax credit for hiring felons. Tax planning, by the way, isn't something you do on April 10th. You don't do it on April 15th. You don't do it on April 1st. You don't do it on December 15th. You don't do it on December 31st. This is something that is a way of life. You have to plan your numbers all year long. You've got to execute this tax plan every day, all year. What you have to do is actually create the numbers that you're going to give to the accountant guy at the end of the year. If you don't create the numbers during the year, you can't make them up at the end of the year on April 10th to give to your tax guy to calculate your taxes. This is something you've got to do every single day. The problem is people don't understand taxes. Let's look at taxes for a minute. There's taxes, all kinds of taxes. Let's look at the income tax. The income tax came in, Section 16 was passed in 1913. And when they passed Section 16, it came in at 8.5%. And within a matter of months, it went up to, well, actually a couple of years, it went up to 75%. Then it came back down, and during the 1920s, this is the 1920s, the tax rate was at 25%. By the way, what did they call the 20s? No, 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 it's not the Depression. They called the 20s the Roaring 20s. The economy went nuts when the tax rate went back down to 25%. This is Herbert Hoover, 1929. This is the Great Depression. Go away. I didn't want you to do that. This is the Great Depression right there. Goes from 25% up to 80%. Would you think that if they raised taxes substantially today, it might put us into a depression? And yet everybody's saying, we got to tax the rich. We got to tax. We got to tax. We got to tax. Well, that's what happened. Do you understand that during the 50s and 60s, you could pay, you could make $1 million and be paying $920,000 of it out in income taxes? That's what's called incentive. Yeah, I'm going to make $1 million. Ronald Reagan, at that point, said, there is no use my making another movie. I don't make any money. The government takes it all. Reagan did something about it. Reagan ran for president. And these two drops in the taxes from 70% down to 28%, that's Ronald Reagan. That's Reagan economics. Everybody said the man was nuts. You can't do this. It ain't going to work. And yet, he made more money for the federal government by lowering the tax rate than they'd ever had before. Then we came along, and this is Clinton, and then these are the Bushy tax cuts, and then we're back up. But do you understand that basically today we are at historic tax low? And yet, you figure the IRS has taken everything. Well, trust me, guys, they've taken a lot more, and in the next few years, I can easily see a 60% tax rate. Hate to break it to you, but that's where we're going. Politicians might not always tell the truth. Would you believe that one? When Section 16 was passed in 1913, the President, Congress, senators, everybody slammed their fist on the desk and said, just let us tax you at 8.5%. We will never, ever, we promise, we swear on a stack of Bibles, we will never raise the tax. Well, yeah, within 4 or 5 years, we'd gone from 8.5% to 75%. Today, we have all of these tax limits. They just put a $250,000 tax limit. Well, that's a lot of money. That doesn't affect me. I don't have to worry about it. Well, once the law's in place, all I have to do is lower the limit. Or we have inflation. 1978, a little tax called the alternative minimum tax came into effect. And, excuse me, not 1978, 1987. And the alternative minimum tax was to tax the rich. The rich have got to pay their fair share. Well, today, if you make $70,000 to $80,000 a year, the alternative minimum tax is going to kick in on you to make sure that you calculate your taxes differently and you pay more tax. I'm sorry, but I don't think $75,000 a year is rich to me. And yet, that's what it is. So when we let the camel stick his nose in the tent and say, oh, just let us pass all this stuff. The Obamacare tax doesn't go into effect until you make $250,000. Everybody's going, oh, that's the rich. Well, that may not be what it is tomorrow, either through inflation or through the IRS just lowering the limit. In fact, if we'd gone off the fiscal cliff a couple of years ago, do you know what the alternative minimum tax level was set to be? $45,000. Anybody who made over $45,000 would have been considered rich and paid the alternative minimum tax. That's what we're talking about. Well, today they don't tax us. Oh, yeah, we got the taxes. We got the income tax, the state tax, phone tax, gas tax, tax. And now they don't call it a tax, they call it a fee. We got the phone fee, we got this fee, we got that fee. Well, they're taxes. That's all they are. I told you people don't understand taxes. Let me do a little demo for you for 2 seconds. Let's take $1 and double it 20 times. $1, 2, 2, 4, 4, 8, 8, 16, 16, 32. You understand where we're going? You do that 20 times, you end up with $1,048,000 and change. $1 million bucks. Not a bad deal, huh? But wait. There's no tax on that sequence. But everything you do is taxed. Your real estate's taxed, your mutual funds are taxed, your stock investments are taxed, your wages taxed, everything's taxed. Okay, let's tax it. We have $1, we make 2. We have $1 in gain, but well, let's say we got to tax 40%. Federal and state, that's not bad, 40%. So 40% tax, we have the $1 in gain, so we got to take a 40 cents off, so we end up with $1.60, which means that we totally end up with, can you see that? I can't see that on my screen. We end up with, I'm going to just tell you, $2.56, or $1.60. Oh yeah, I'm okay. There we are, $1.60. I'm just not thinking right. You double $1.60, you get $3.20. That's right. Okay, but I got $1.60 in gain, so I have to take 40% of it, so I end up with $2.56. There we go. We're okay. Everything's cool. We double it $2.56. We get blah 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 blah. You end up with $4.10. Y'all understand what we're doing? On one hand, we had $1 million. Double it 20 times. In this case, we've taxed it at 40%. You've just lost 40% of $1 million. That's what, 400,000? So instead of $1 million, I only have 600,000 left. Now wait a minute. $400,000 is a big deal to me, you guys. I don't know about you. Maybe 400,000 is chump change to you, but it's a big deal to me. So we've got the $400,000 that we lost, right? 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 Do I really have 600 left? The answer is no. We have less than that. Because basically what we're doing in this case is we're taking compounding interest in reverse. You've all heard the eighth wonder of the world is compounding interest. Well, this is the eighth wonder of the world in reverse. You don't end up with $600,000. You end up with a grand total of $12,089. Now let me think. Would I rather have $1 million or 12,000? The only difference here was a 40% tax. Now I told you that our goal was to cut your taxes 10 or 20%. That doesn't mean just a 10 or 20% increase in your wealth over the next 20 years. That is a huge increase in your wealth. Can you see why? You can't find me one person who can say, wow, my broker made me rich. You can't do it. Now you can find me people who say, I've made money in my IRAs with my broker. The broker didn't have any more skill in managing the money in your IRA than he did in your standard accounts. The difference is the tax treatment of the IRA outran the stupidity of your broker. That's the difference. So, cutting taxes is a big deal. Everybody understand that? Nod your heads. I want to hear them rattle over the internet. There are 3 ways that you can control taxes, and there are only 3. You can postpone the tax. Give me an example. Well, if I put my money into a 401k, I have to pay tax on it 20 years later when I take it out. I postponed the tax. If I do a 1031 real estate exchange, I postponed the tax. I can change the nature of the tax. If I have an investment and I hold it for 11 months and I sell it, what type of income do I have? Short-term capital gains. If I hold the investment for 13 months and sell it, I've changed the nature of the tax from short-term capital gains to long-term capital gains, and that's a different tax. Could I take earned income, the salary that a doctor gets, convert that into passive income? And the answer is yes. There are techniques that we can do that. Passive income is taxed at a different standard than earned income. So it's a big deal. Or we can shift the tax. That means we make somebody else pay it. We have the kids pay tax on money the family receives because the kid is paying tax at a lower rate than daddy's tax rate in many cases. Now we've got to follow all the laws to do these things, but these are not tricky. This is just standard tax stuff. The problem is your tax guy doesn't plan for you. You've got to lower your adjusted gross income, your AGI, adjusted gross income. As a person There's nothing you can do to lower your AGI. Charitable contributions, they don't do anything to your AGI. Your home mortgage deduction, that doesn't do anything for your AGI. Your medical deductions, these are all things that your tax guy has told you are important tax shelters. That's not true. Well, yeah, these are nice tax deductions, but they don't really lower your taxes. Your business, though, your real estate investing, can lower your taxes. There are 4 functions to every type of business tool, whether it's a corporation, whether it's an LLC, a partnership, it doesn't matter. The tools are used for management, asset protection, income taxes, and estate taxes. We're going to concentrate on the income tax aspect of using a business structure. We're going to cut the taxes. We're going to control the AGI. That's what we need to do in order to make things work. Your adjusted gross income, what is it? Well, it's the magic number. It determines which tax bracket you're in. If I can lower my adjusted gross income, then maybe I could drop myself into a lower tax bracket. If you can drop yourself into a lower tax bracket, you're going to save a lot more taxes. It isn't just a deduction that we're out after. It's how to drop a tax bracket, how to lower your adjusted gross income. If I can lower my adjusted gross income, I get to take advantage of my itemized deductions. They phase out at a certain adjusted gross income level. The exemptions phase out. Your tax care credits, they phase out. If you're over a certain AGI, adjusted gross income, you can't do a Roth IRA. And I told you earlier, if your AGI is above 75, 80,000, 87,000 today, you're going to be paying alternative minimum taxes. And of course, if your AGI is high enough, you're going to be paying the extra Obamacare taxes, which amount to about 8% more just tacked on top. So, how do we control this magic number known as the adjusted gross income? You have to understand what above-the-line accounting and below-the-line accounting is. Now, what's the line? The line is the last line on page 1 of your 1040 form, the form you use to fill out your taxes. Anything above the last line on page 1 is above the line. Anything below the line, anything on page 2, is below the line. Actually, the adjusted gross income is the last line on page 1, and it's the top line on page 2. Above the line, below the line. If it's below the line, it doesn't affect your adjusted gross income. You look at your tax return. The mortgage, home mortgage, is below the line. Medical deductions, below the line. Charitable deductions, below the line. Most tax planning is done below the line. You're going to have to do things above the line that affect your taxes. Your company can work above the line. You can't. Basically, the only thing you can do above the line is make a contribution to a standard, not a Roth, a standard IRA. That's above the line. That's the only thing you can do. Oh, and if you're a teacher, you can buy supplies on the 3rd day of the 4th month of the 6th year, and those are deductible above the line. Moving expenses are deductible above the line. Well, did you move last year? I don't think so. So that sort of stuff is above the line. Anything you do in your company or your real estate investing is above the line. So let's look at how we get above the line. The biggest question is for you right now, and I'm not going to go into all the accounts of company. are you going to use? I'm going to tell you just straight up, and we're not going to have the discussion. And there are reasons and advantages and disadvantages, reasons not to, reasons to have a limited liability company. I'm going to tell you, have a limited liability company. I'm pretty safe in telling you that. With the limited liability company, you're going to double your asset protection. You get the corporate shield. It's the same corporate shield as you get in a corporation. But you also get a reverse asset protection. We protect the company from what happens to you. The corporate shield protects you from what happens in the company. But we've got to protect the company from what happens to you. What happens to your company if you get divorced? What happens to your company if you get sick? And by the way, this asset protection stuff that we talk about, we're not talking weird, people say all the time to me, I don't have to worry about asset protection. I'm a straight guy. I don't do shady deals. I don't cheat people. Nobody's going to sue me. My rental units, they're nice, they're clean, they're new, there's no lead paint. Asset protection is personal. 56% of all bankruptcies in the United States are a result of somebody in the family gets sick. That's all it takes, guys. What's going to happen to the assets in your company, that rental unit that you put into the company, the LLC, the corporation, what happens to that rental unit when you get sick? Or when your son or your daughter, they get sick? Are you going to lose that asset? Well, I can tell you, unless you do it right, yes, you are going to lose it. We need to have what's called charging order protection, and your attorney's never brought you in and set you down and talked to you about lowering your adjusted gross income or making sure that you have charging order protection. You've all been to the lawyer, you've all been to the CPA, and never have they used the words adjusted gross income or charging order protection. Those are two of the biggest concepts in accounting and asset protection. It's time you learned about them. That's why Ted asked me to come and talk to you this evening about charging order protection and adjusted gross income. Let me give you 2 seconds of history for a limited liability company. A limited liability company is basically an old European entity. The LTDs in England and the GmbHs, Gesellschaft mit beschränkter Haftung, company with limited liability in German. They've been around for a long time. 1977, Wyoming decided that they were going to create a limited liability company. They basically took half the genetic material of a corporation and half the genetic material of a partnership and put them together to form a new type of business entity called a limited liability company. The major question was, how are we going to tax it? They submitted that to the IRS in 1977, and they basically figured the IRS would come back and create a new tax code. When they'd asked for a small business company, they created subchapter S of the IRS code, and you got the S corporation. We expected the IRS to create a new type of taxing structure. Well, it took until 1996, 20 years, for the IRS to come back and say, hey, we don't care how you tax it, check the box. Do you want it taxed as a sole proprietorship, as a partnership, as a S Corp, as a C Corp? We don't care. You check the box. Now, corporations limited liability companies wandered around for 15, 20 years. And finally, in 2006, we got what's called the Uniform LLC Act. And most all the states have basically adopted the Uniform LLC Act. So today, LLCs are very uniform state. Now, there are little differences. I understand that. but basically the same. Do not be afraid of using an LLC. Taxes are taxes, and asset protection is asset protection. What do I mean by that? Well, I told you that it was a check-the-box deal in 1996. That means you get to have your LLC taxed any way you want. It needs to be written into the operating agreement, and you can have it taxed under the laws of a partnership, a sole proprietorship, an S Corp, or C Corp. By the way, if it's a sole proprietorship, it's what's called a disregarded entity. You have your LLC, the IRS disregards it. If anybody asks you for a tax ID number for your LLC, it's your Social Security number. You file a Schedule C, and that's it. But you need to have the attorney write it for liability shielding also. The operating agreement controls what's happening. I happen to write my documents for the tax laws and the liability shield, which is what you need because it has to address both issues. But they're independent of each other. The question is your corporation taxed under Chapter C of the IRS Code or Chapter S of the IRS Code? Is your LLC taxed as under the partnership rules, under the S corporation rules, or under the C corporation rules? They're tax terms, not business structure or asset protection terms. So Canadians, you're doing the tax liens, you're doing the tax deeds, whatever it is, you're going to have it taxed as either a sole proprietorship or a general partnership. Now that says nothing about what happens when you try and bring money back into Canada. When you try and bring money back into Canada, it's basically going to be taxed as if it were corporate tax or corporate money. So in the U.S., depends on how you make your money. Is it passive income or earned income? I'm going to wander around here for a little and talk about your LLC. The question is, who owns your company? Who owns your corporation or your LLC? That should be your living revocable trust. The name that you put on as member, the stock certificate you make out, the shareholder is your living revocable trust. Your living revocable trust, by the way, has 3 parts to its name. It has the name of the trust, the John Doe Trust, the Ugly Lamp Trust, whatever you named it, the 6430 Roosevelt Drive Trust, whatever you name it. The name of the trust is one element. The date of the trust is a second element. Your trust was created on a specific date. I have to have the date. The third thing you have to have is the name of the trustee. You, trustee. John Doe, trustee. So I've got to have the name of the trust, the date of the trust, and the trustee. If you do not have all 3 elements on your stock certificate, on your membership certificate, on the deed, on the checking account, on the tax lien, then you have bad title. So, 3 parts. The AIN number, employee identification number. Now, if you're in Canada, you're going to come down. If it's a company, you get an EIN number. If you're just doing business as a sole proprietor, you're going to get a TIN number, tax identification number. The EIN, the employer identification number, you don't get one until you have to have one, until you're making money, until you're paying employees. You don't have to have one. And by the way, there's a little bippy that everybody needs to be aware of. About 8 or 9 years ago, the IRS instituted a new plan. And I've got to change this slide. I hadn't realized that. For every month that you do not file your taxes, you are late if you are a corporate tax structure. Now that could be an LLC taxed as an S Corp or a C Corp, or it could be a corporation taxed under Chapter C or Subchapter S. For every month that you do not pay your taxes, the old number is $135. They've just increased it. It's now $195 per month per stockholder or member. And I have people who set up the seminar guy talked them into setting up a Nevada corporation 10 years ago. And they dutifully got this guy a tax ID number, an employer identification number. They never did any business with the Nevada corporation. They never filed any taxes. Nothing ever happened. These people are now getting bills from the IRS, $60,000, $70,000, $80,000 just because they never filed a tax return. And the IRS is dead serious. By the way, we have a new individual in our office. This individual spent the last 7 years as a special auditor of the IRS. There's only like a dozen of those guys in the United States. He quit. He's not old. He's about 40. He quit. He came to work with me about 4 or 5 months ago, and this guy's very good. And I've seen him get people out of holes. So if you're in a hole with the IRS, maybe you'd want to give us a call. But this $195 per month bill is a big deal today. Changing the tax structure. If your company is not being taxed properly, you can go back and you can change the tax structure. You can do that two ways. You can start over. Now, you don't have to start over. You don't have to start over. You can simply go in and file with the IRS at the first of the year a tax change. Now, before the last few years, you had to get special dispensation from the IRS in order to make this change. It was a big deal. Today, the IRS will basically give you a freebie, one freebie. You can file with the IRS. You have to do it in the first 30 or 45 days of the year. You can file with the IRS and say, we want to change how our company is taxed. So you can do that, figure out what's the best tax structure with your CPA guy, and then make the change, all right? So these are realistic goals, I think. Save you 20% on your taxes. Now, you got to keep it clean. We're going to use nice black letter law. That's what we've just discussed. And there are lots of things that we haven't discussed here that we probably should discuss. But those are for other Tuesday evening events that Ted has. And I'll probably be back. Ted's a persuasive character. I know that. He persuades me to do all kinds of interesting things. Love Ted, though. But we need to talk about some specific business tricks that we can use for taxes. And I'd like to talk to you about tax scams, but we don't have quite time for that. Let me just throw out one tax scam radar thingy that you can use. If anybody ever presents you with a scheme that says that you are never going to pay tax, you're going to earn money and you're never going to pay the tax, then you know that that is a tax scam. And you run the other way, all right? Those are the things that we wanted to talk about tonight, Dawn. This is my last slide, and so we're pretty much through with the formal presentation.
All right, Lee, we have some questions coming in.
Gee, I've gotten a bunch more. Let's see. What are the ramifications of if the LLC is owned by the living revocable trust, is not owned? We have several LLCs not owned by the trust. Well, the ramification is when you die, this is a probatable asset, so you may have to end up probating your LLC, or your family would end up probating your LLC, and you don't want them to do that. About 85% of the companies die when the owner dies, And one of the main reasons is the LLC or the corporation or the partnership or whatever it is gets caught up in the probate system, and it takes a year for the attorneys to get it out of the probate system, and by that time the company's dead. Informative and clear. Thanks. We'll figure this out after the course. We hear you fine. What about dealer status? Dealer status depends to a great degree on your state and different laws. I'm not too up on dealer status. If you are considered a dealer, then your real estate is considered inventory, and it is then not passive income. It is then active or earned income, which is the problem. What state would you recommend to set up an LLC, New Mexico or Wyoming? It's all a crock. Would you like me to spell crock? You do your corporation or your LLC or your business in the state where you own real estate or where you are doing business. This, we're going to do it in some other state, is just a bunch of BS, and that's a whole nother webinar that we have to do someday. I had my accountant file for my LLC but did not have it put in the name of the trust. What should I do? We've answered that one.
Okay.
If I set up an LLC to buy tax liens and the LLC is inside a self-directed Roth IRA, what's my tax burden? Well, you're doing what's called an IRA LLC. I don't like them. I don't know that they're illegal, but all of my gut feelings say they're illegal. One of the first things I had the guy do when he came to work at my office was I asked him to find out the legalities of an LLC IRA LLC, however you want to call it. And he's been working on it, but the fact of the matter is he's contacting all of his high-level buddies in the IRS and saying, what about this LLC IRA stuff? And they're saying, we don't know. The LLC IRA, in my opinion, violates all of the self-dealing and prohibited transaction rules. There are millions of people doing it. I will give you that. That doesn't mean that it's legal. And the problem is that there is no statute of limitations for the misuse of an IRA. So the IRS can come back 10 years from now and claim that you did things that were bad. And the problem is the penalty is the seizure of the IRA. You lose the IRA. So I don't know what to do. I don't like it. The tax burden is everything's going to pass through. Now, remember, I told you that one of the scams was, if you can show me a scheme where you can earn money and you can ultimately spend it without ever paying a tax, that's a tax scheme. Now, if the IRA is a pass-through IRA, you earn money in it, it goes into your Roth IRA, there's no tax there because you passed it through to the IRA, and then it's a Roth IRA, so you get to spend it without a tax. That's a tax scam. I will tell you that point blank. It's probably enough on that one for now. Is it better to put rental properties under LLC than own names? Yes, usually it is better to put it under the LLC because the LLC gives it asset protection that you don't have if it's under your own name. And it also gives you asset protection that you don't get if it's under your own name. You are saying we have to file with the IRS for LLC monthly. I'm not sure I said monthly. If I did, I apologize. You file with an LLC quarterly in some situations or annually. You never have to file monthly. I'm sorry if I said monthly. Can Canadians do business in the U.S. with a Canadian company? The Canadian company would have to be registered in the U.S., and you almost may as well just set up a U.S. company. It's probably going to be easier in the long run. Can we get a digital copy of the slides and notes? Probably not. One, I don't have any notes, and two, the slides are awful big to send out, and they're not that fancy anyway. Can you say a few explanations about family limited partnerships, FLPs, please? You've talked a little bit in Las Vegas seminar in Phoenix. The limited partnership, family limited partnership, is just like any other limited partnership, except the family members become limited partners. And limited partnerships have many of the same aspects of the charging order protection that an LLC has, but they lack the corporate shield that a corporation or an LLC has. Today, I would probably never use a family limited partnership for anything. I would substitute an LLC for the family limited partnership. As far as I can see, does it matter which state I set up my LLC in? Yes, you're going to set it up where you are doing business or own property. I am a New Zealand citizen with a permanent U.S. and my husband is American. Are there any special considerations for us to consider? What are the implications for Canadians to consider? You're going to have him own the companies and stuff. The problem is estate taxes. You're going to get killed on estate taxes, and we won't go into that. I'm setting up an LLP to donate a property to charity, $3 million. My plan is to have 35 partners. What are the implications for Canadians? I don't know. You're over my head on that one. I think that's all of them, Dawn.
Okay, well, I appreciate it. Thank you, Lee.
Hey, good night, everybody.
Good night.
Good night, Dawn. Good night, everybody. Thanks for listening in. Bye.